When you think about banking in India, you might picture a QR code and an instant payment on your phone. But have you ever stopped to think about how we got here? From old, dusty ledgers in the colonial era to a single tap on a screen? Well, that story is one of the most incredible financial transformations you'll ever hear. And today, we're going to unpack that whole journey.
So really, how did this happen? How did a system that was once a total mess, just a bunch of small, unstable local banks, turn into this digital powerhouse that moves billions of dollars every single day? That's the big question we're diving into.
To really get it, we're going to walk through 5 key chapters. First, we'll start in an age of pure chaos and see how control was established. Then, we'll look at how banking was redesigned for the masses, not just the rich. After that, a new era of fierce competition, followed by a digital revolution that changed absolutely everything. And finally, we'll land on the complex, fast-moving system we see today.
Okay, let's kick things off. Our story begins before 1947. And honestly, it was a pretty chaotic time for banking. The main goal wasn't innovation or growth. It was just about survival, about trying to bring some kind of order to a financial landscape that was basically the Wild West.
You know, modern banking in India has roots that go way back. You had these big, important institutions called the presidency banks, which eventually merged into the very powerful Imperial Bank of India. But here's the thing. These banks mostly cared about serving European businesses. And while they were growing, the ground underneath the entire system was super shaky. This instability is what ultimately led to a crucial moment, the creation of a central bank, the Reserve Bank of India, or RBI, in 1935.
And here was the huge problem. Most banks back then were tiny, private operations, kind of like little local startups with not a lot of capital. This made them incredibly fragile. It wasn't just economic downturns that could knock them out. Sometimes it was just straight-up fraud. Bank failures weren't a rare thing. They happened all the time, completely wiping out the savings of ordinary people.
So something had to be done, and this is when a really powerful idea started to take shape. A group called the Hilton-Young Commission basically said, look, to make this system stable, you need an independent referee. You need an institution that can manage the country's money and credit without getting tangled up in everyday politics. This was literally the blueprint for a modern central bank. And that's exactly what happened. The RBI was created to be that referee, that financial firefighter. Its whole job was to step into the chaos, bring some order, and make sure the banking sector could be a strong foundation for the economy, not something that could collapse at any moment.
All right, let's jump forward in time. After India's independence in 1947, the entire mission of banking just flipped on its head. It wasn't just about keeping businesses stable anymore. Now, it was about using the whole financial system as a tool to build a new nation, and importantly, to reach every single citizen. But there was a new, glaring problem. The banks were all in the cities serving businesses. This meant that the vast majority of the population living in rural India was completely left out. For a brand new country trying to grow its agriculture and develop the whole nation, this was a massive roadblock. This meant there had to be a total shift in philosophy. The country needed to move away from what you could call class banking, which was all about serving the elite and big businesses, to something called mass banking. The idea was to build a system that gave loans to farmers, to small industries, to regular people all over the country. The goal was to turn banking from a private luxury into a public utility. So the government did something pretty radical. The thinking was, if private banks won't serve the masses, then the government will just take over the banks and do it itself. First, the RBI was brought under public ownership. Then that old imperial bank was transformed into the State Bank of India, with a clear mission to expand into rural areas. And then came the biggest moves, 2 huge waves of nationalization, taking over dozens of major private banks. And the scale of this takeover was just unbelievable. By 1980, the government controlled about 92% of all banking assets in the entire country. Let that sink in. This was a complete overhaul of the financial system, putting the government firmly in the driver's seat of the economy. But, as you can imagine, a system completely controlled by the state created its own set of problems. And that brings us to our third major era, which kicked off in 1991. The focus was about to shift dramatically from state control to efficiency, technology, and good old-fashioned competition. So what went wrong? Well, decades of state control led to a lot of inefficiency. Bad loans were piling up everywhere. And for the average person, customer service was just awful.
We're talking about endless lines, mountains of paperwork, and this general feeling that the bank was doing you a huge favor just by existing. With no real competition, there was just no reason for them to get any better. The whole system was stuck.
The big change came with the massive economic reforms of 1991. A committee with a very influential report basically advised the government to open up the banking sector. The goal was to inject some serious competition by giving licenses to new private banks and forcing the entire system, public and private, to get its act together and modernize.
And just like that, a whole new generation of banks appeared on the scene. Names like HDFC and ICICI, they were tech-savvy, they were customer-focused, and they introduced things that seemed revolutionary at the time, like ATMs and phone banking. It completely changed what people expected from a bank and raised the bar for everyone.
Now, this new foundation of competition and technology set the stage for the most powerful transformation yet, the digital revolution. This next chapter was all about finally connecting that last billion people who were still left out of the system.
See, even after decades of nationalization and then liberalization, a huge challenge remained. It's often called the last mile problem. There were still millions and millions of people, especially in remote villages or low-income households, who were completely outside the banking world. Reaching them was the final frontier.
And this is where the strategy got really clever. Instead of trying to make one type of bank fit everyone, the RBI introduced new kinds of specialized or niche banks. You had small finance banks, which were designed specifically to give loans to small businesses and farmers. And then you had payment banks, which couldn't give loans, but offered super simple, low-cost accounts for deposits and payments, perfect for migrant workers and low-income families. It was a really targeted solution.
And then came the game changer of all game changers, the Unified Payments Interface, or UPI. It was this brilliant, simple platform that connected every single bank together. It let anyone with a bank account and a smartphone make instant payments 24/7. This one piece of technology basically leapfrogged decades of building physical infrastructure and put the power of a bank branch right into hundreds of millions of pockets.
So, that long and winding journey brings us to today. After all these changes, what does the Indian banking system actually look like right now?
What we have is this incredibly complex and diverse ecosystem. Now, don't worry about trying to read every box on here. The main thing to see is the structure. Right at the top, you've got the RBI, the master regulator watching over everything. And below it, you have all the different players we've talked about. The big public sector banks, the nimble private banks, the cooperative banks, and all those specialized banks. It's a mix of everything, all working together in one interconnected system.
So, if we boil this whole story down, you can really see four massive transformations. First, the system went from total instability to having a strong central regulator. Second, it made a huge philosophical jump from serving the elite to aiming for mass financial inclusion. Third, it shifted from a state-run monopoly to a market-driven competitive industry. And finally, it made the leap from brick-and-mortar branches to digital-first banking in your pocket.
And that leaves us with a huge question for the future. As banking becomes more and more digital, almost invisible in our day-to-day lives, what's the next great hurdle? Is it defending this massive digital system from cyber attacks? Is it figuring out the rules for artificial intelligence in finance? Or is the biggest challenge making sure that in this new digital world, we don't accidentally leave the most vulnerable people behind? That's the next chapter that's still waiting to be written.